Hey, everybody, little end of the week recap. So, darn it, it stunk this morning to wake up and see that jobs report come in above expectations, and this happening just days before the Fed, right? But a couple of things to think about. Number one, we've been watching that movie all year. Every single jobs report has been coming in above expectations, and everyone has a backward revision. Heck, there was even a downward revision within this report. That's why bonds aren't nearly as bad as they were when the report hit. But when you looked under the hood, when you looked at the kind of where did the jobs come from, that's where it gets kind of funny. Of the 200,000 jobs, let's call it, half of them came from strike workers getting back to work and the government. We can't rely on the government to create jobs, to create economic growth. And so we think it was just an okay report. And speaking of growth, what we're not hearing right now, I remember Janet Yellen, darn it, on late October, she said the reason why yields were high is because the economy is so strong. She basically set off the rally in the bond market. It was almost that date. The 10-year note was like just above five and it went to four and change. That's because the Atlanta GDP now, the Fed, they are now forecasting, and they were right on the third quarter. They called it around 5.2%. They are saying the fourth quarter is going to be 1.2. So we are hitting a wall on growth. And that's probably why the Fed's not going to do anything. Remember, we're also going into an election year, right? And something we always say when we're at seminars and to our mortgage market guide members, good things happen in election years. You start to see it. The oil prices have come down. Things have all of a sudden magically changed, magically get better. And so I don't see any world where the Fed's going to heavy hand and put us into a recession. So there won't be a rate hike next week, but we'll have to watch. We can't bank on them doing a victory lap saying we're done with the job unless Tuesday's CPI number comes in light. Now, Tuesday, we're getting CPI. Fed's been watching it. There are some folks on Wall Street and some thinkers that the headline number, the month over month headline number, could show outright deflation, not disinflation where prices are going up slowly, but deflation, outright contracting. It's really tough to justify any further rate hikes if you have anything even close to deflation. So that's going to be interesting. But on top of all of that, we have to watch the auctions. Next week, our Treasury Department will be back peddling a bunch of paper, 10s and 30s, a lot of long term stuff. And after watching yields go from the fives to the low fours, what will the appetite be? Because if the appetite's not great and the Treasury has to issue more yield, things can get weird. So listen, probably have a lot of folks out there floating, thinking about it, waiting. You might want to start to gather some people up, watch this thing very closely. And then lastly, what I'd leave you with, just the technical stuff. The 10-year note, 409, has been a ceiling all year long, right? Hitting it and moving lower. It will now be support on the way down, kind of preventing yields from getting better. But then right underneath that, obviously, is a nice psychological level of 4%, but also the 200-day moving average of the 10-year note yield is at 4%. So you got 409 and 4%, probably going to be pretty formidable. So we're going to need some bond-friendly data, but what will be great, we get beneath that, we're going to know it's a party. But be careful out there. Have yourself a great weekend, and we'll be talking to you soon. Bye for now.